Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi, I'm Steve Brice, Group CIO, and I'm speaking to Mark Carney, former Bank of England and Bank of Canada Governor. Let's get started in terms of the three topics, so macro, environment, climate change, and then we'll talk a little bit about cryptocurrencies as well. So we've got a fairly packed agenda. So in terms of macro, I guess we have to start with, this is the most predicted recession that I've certainly seen in my career. Normally economists are very good at predicting recessions as they've finished or around that sort of time, which is not super helpful. But do you share the concerns in the US and Europe that we're going to see a recession this year or next?
Yeah, well, I think you're framing the question the right way, Steve, which is there are recessions and then there are recessions. So it's about location, but also duration, depth, characteristics of it. And I think the picture is shifting as we speak, and I'm sure we'll come to this. I would differentiate between recessions in G7 countries, specifically the US, the UK, and Europe, and the global outlook and the Asian outlook as well. Arguably one of the biggest macro events, maybe the biggest macro event of this year, happened last month at the end of 2022 with the reopening in China, accompanied by a number of structural policy shifts, the removal of the three lines in property, greater engagement, some greater clarity in the tech sector in China. All those aspects should provide, as we get out of this quarter, arguably, and into the balance of the year, quite a big stimulus to the global economy and some momentum. But let's go to where the challenges lay, which are first and foremost actually in my old hunting ground, if you will, the United Kingdom, which is in effect in recession. It has the challenges that the US and Europe has, and then on top of it, it has the added challenge of the adjustment to Brexit. So you have in the UK an economy that is weaker than Europe, which is being hit by the energy shock and other forces, but has a labor market that's tighter than the United States. And that brings me to the US, where I am in the camp where that it is almost certain that the US will enter into a recession. I would think sometime around the middle or third quarter of this year. And when I say it's almost certain, it's because it needs to. It needs to rebalance an economy that has too much demand for the supply potential of the economy. That's a product of, yes, partly a lot of stimulus coming out of COVID, both by the government and the series of fiscal packages, but also the Fed waiting too long, and I think they would acknowledge that. So it's partly that, but it's also because of bigger forces from COVID, from the rewiring of the global economy, from the energy shock, a series of supply shocks to the U.S. economy. We're all facing these, and that's put the economy out of balance. And so we're in a situation right now, people have been talking about the prospect for a U.S. recession for several quarters. The U.S. economy has had more momentum, so that meant that it's been delayed. But the punchline here is that a recession delayed is not a recession avoided. In order to get inflation under control, they need to have a period where the growth of demand, or the shrinking of demand, is much less than the relatively meager growth of supply. And that's why the Fed has been as aggressive as they have been. I think they'll have a recession, as I say, beginning probably around the third quarter. Last point, if I may, and head back, which is, but as I said at the outset, there are recessions and there are recessions. And this is not the U.S. economy or the European economy of 2007-8, where there were big imbalances in the economy, in household debt, big imbalances in the corporate balance sheet, big imbalances in the financial sector, which caused the recession. Actually, it's the reverse. In all three cases, they're relatively robust. And that means that the prospect of, as inflation gets under control, and we can talk about exactly what that means, but as it gets under control, we have the prospect of emerging from this period of a slowdown in a much better position for the global economy. And I think that's what you and Ray alluded to it, as we shift through the year, markets look forward and they're looking forward to a better environment after a tough period.
So I guess that one of the questions that people have, obviously in the past 12 months, we've adjusted from zero interest rates pretty much to significantly higher interest rates. I mean, you and I are old enough to remember where this is still quite low, actually, right? Or certainly not high.
Yeah.
Do you believe that this is the new normal, or do you think when the recession hits that we'll get the Greenspan Bernanke put coming back and we go back to zero QE and business as normal as we've known it for the last 10 years?
Exactly. So this is a critical question for the global economy, for policymakers, for portfolio construction. And I do think we're in a regime shift, but not a paradigm change. And so the economic paradigm hasn't changed, but we're in a regime shift in the sense, and I'll put it in personal terms. Look, I started in finance a few months before the fall of the Berlin Wall. I was working in the City of London. They have the fall of the Berlin Wall. That kicks off a process. We all lived through it. We all benefited from it, of global integration, of liberalization, of convergence of economic policy, tremendous wealth creation. But what happens from a macro perspective is that is a disinflationary environment. So we have prices are kept down as a consequence of the integration. I'll simplify it to the integration of China into the global economy. It's much bigger than that, of course. On top of that, what happens with the global financial crisis after that is the world, and certainly the G7 operates in a world where there is too little demand in the economy. And central banks are operating in an environment, and virtually the whole time I was a central bank governor, this was true, where the issue is that inflation is below target and economies are operating at less than their full potential. So both sides of the equation say stimulate. And the only question is how much? How do you calibrate that stimulus? And on top of that, the last factor in this regime, the old regime, not where we are now, is that these forces of secular stagnation, savings because of demographics, less investment because of asset-light economies, all those forces keep down the level of interest rates at which the economy clears. So those three forces are there. Fast forward to today. Now this process builds over time, but it crystallizes with the Russian invasion of Ukraine, that we have a couple of factors which move us out of a world where there's been too little demand to having a problem with supply, a series of problems with supply. Some of them are short-term. They're in the commodity markets. We have an energy shock. Some of them are medium-term, and we'll come to this, which is the transition towards a more sustainable energy sector. Some have to do with COVID and the aftermath, which we all hope it's not short-term, it's sort of medium-term, but it will ultimately fade, and we're working our way through it, and China's steps are part of that. Then we have much bigger issues where we all have a front-row seat here, which is the rewiring of the global economy. Supply chains, people learn that it's dangerous to have very thin, concentrated supply chains because of weather, because of COVID shocks, and because of geopolitics, the new component there. And if I wrap that all together, it's basically a world that's moved from a high value, absolute priority on efficiency, which is this global integration, to a high value on resilience. That makes sense. It's better to put money in your health system. Unfortunately, there's some tough parts of the world you got to spend on defense. You should have capital in your banking system. We should invest in the climate transition. That all makes sense. But those are all costs. And those are insurance premiums, if you want to think of it one way. And the point is that as we get out of this period, which, the next couple of years, in my view at least, these forces are medium-term forces. So we've moved from a world where the global economy imparts disinflation, low prices, to imparts inflation. Now, last point, we can deal with that. It means slightly higher average interest rates. It means recognizing there'll be some volatility of inflation. It means spending on smart policies to address these structural supply-side issues. But it is a different investing environment. It's one with higher resting interest rates, as I say, higher average inflation and some volatility in inflation, and you've got to put that into your equation when you think about how to construct portfolios and build wealth.
Okay, I want to pick up on your smart policies point. So about the obviously the smart policies that Liz Truss employed
yes.
in terms of. So what does this all mean for fiscal limits? I mean, obviously the UK was an interesting case study in what not to do. What does it mean for other countries?
Yeah, it's well. This is I'm going to appeal to your safe element of your portfolio, which is I think there are very important lessons from what happened in the UK. A couple of quick points. One, what Liz Truss was trying to do was the right thing. She had the right objective. She was trying to double the rate of growth, trying to attack the supply side, but went around it in the wrong way and paid a very quick price for it. And there's a real market lesson for it. So why did the markets punish the UK? You had unfunded tax cuts. You had no prospect of balancing these budgets aside from rhetoric, in effect. That environment is over. We're no longer in a zero interest rate environment where money is and liquidity is very high. So sovereigns, companies, corporate credit will be judged on the basis of their fundamentals. That's a good thing, by the way, because that brings discipline, but it's a different environment.
Yeah.
The second thing that they didn't do is they worked at cross purposes with monetary policy. So we're in an environment where in the United States, in the UK even, largely because of Brexit, in Europe as well, there is too much demand relative to the supply potential of the economy. You do a big fiscal package, I mean, people are hurting, but if you do a big fiscal package, you're adding to demand, you're making the problem worse for the central bank. That just means interest rates have to go higher. And it takes away, and it's destabilizing in that respect. The third point I'd make is that I think that one of the general lessons I would take from the experience in the UK is, look, there will be accidents, there will be volatility over the course of this year and into next year. Because we're in a rising rate environment, because the market is still, it wants to believe at least some return to the way things used to be. It wants to go back to that low inflation, low interest rate environment. There's been a begrudging acceptance that the Fed may go to 5%, but it's almost as if all the chips are on 5% in terms of Fed fund rate.
And you think they can do more than
I
that,
think they
right?
can do more. Certainly the balance of risks is that they will go higher than that because inflation proves more persistent in the U.S. So there's people who are positioned, there's segments of the market that are positioned for a relatively benign outcome. And if the Fed has to go higher, which it could well do. I personally think probably 5.5, maybe a bit more. If it has to stay longer, we have a slightly different view on this, which is what makes a market. But I think it's reasonable that they will stick at the level they get to through into 2024.
Okay, so let's pick up on that.
And could I just make two other quick points, which just so I get them on the record in case they haven't, which is Japan is almost certainly going to have to exit yield curve control. That is a very difficult thing to do. That can bring volatility. It will take tremendous skill in order to do that. So, and then you have also potential pressures that could come if, an important point just again to get on record, which is the market thinks inflation is coming back to 2% in the U.S. What if it doesn't? What if it comes back substantially but ends up just around 3%, maybe a little less than 3%, that trade-off with much higher unemployment already, inflation's still sticky. What if it takes longer, and how do markets reprice for that? Sorry.
No, I was interrupting you. I guess one thing is, one of our things, not a question but more a statement for the audience is, if your view on the Bank of Japan means that yen loans would be very risky in this environment, right? Because the yen could strengthen very significantly.
I think one of the things we're seeing, and you have elements in this, which is that, and this is good. There's a lot of good in what's going on right now. But one of the things is we're going to have different motors, and we're going to have more divergence in central bank policy. Therefore, and we've had extreme dollar strength, so likely the dollar giving up some of that, and more volatility in currency markets as a consequence of that. By the way, I'll state the obvious. Last year was a painful year But it was the start of a year of moving from this old equilibrium with rock bottom interest rates to one where in the end the resting place is going to be a more normal level of interest rates, a more normal level of for treasuries and bonds, and people actually getting paid. This would be nice to get paid for lending to your governments, right? Instead of lending for free. So, but there's a lot of markets that need to adjust to those realities.
Okay, so moving just very quickly, just last question on the US, and then I want to get on to China. So the Fed, in your view, hikes more and then holds through the rest of the year, right? So what makes them cut?
What makes them cut? Great question. So obviously, well, I shouldn't say obviously. I mean, what they'll be looking for and are looking for in terms of timing this point at which they begin to hold, they get to the peak, is a sustained deceleration in core inflation. As you know, there's various ways to measure this. I would focus in on the 3 months, sort of what's happening on 3-month core inflation and how that's moved. The Fed is its own entity, but the Bank of Canada, my old shop, they've been very focused on this as they get, because they're closer to getting to this point where they would potentially stop. So that's the first thing. But then I think your question is also about, well, where do they start to pivot as well, more broadly? And a lot of the focus here will be about the labor market. And if I can just I'll make a quick point there, but before I do, I just want to make a reassuring point, if I could, about the inflation situation. Is one of the lessons I would take from the performance of inflation over the last 15 years is we still do understand the inflation process. You often get people saying, well, this doesn't, we don't really understand inflation. No, that's not true. We had a commodity shock, which was a big component of it. We had a shock to durable goods because of COVID, and that flowed through. I mean, we had these crazy used car prices and other things in the U.S. We had the chip shortage and other factors which are driving things. Now what we're largely left with is domestically generated inflation through the services sector. The core of that, there are other components, but the core of that is the labor market. So the Fed focused in on the labor market. What should we look for? Obviously, we look at unemployment. We look at where wages are going, hourly earnings, but you look at more specific things, as I know you do, the Atlanta Fed tracker of wages, the employment cost index. These are better measures of wages. And you look as well at what are called continuing claims. So in the unemployment market, that's running at about 200,000 or so at the moment. That's got to tick up to kind of, well, probably about 600,000, I think, before we get to a point where this starts to soften enough so the pivot is really there.
I guess we were talking about it earlier. Every headline you see is people cutting jobs. But then you look at the jobs numbers, they're still incredibly strong.
Yeah,
right?
and key point, and one of the key things to look at. So let's say you just discount everything, and perfectly valid to discount everything that I just said about the U.S. economy. And if I were, I'm going to paraphrase what a Fed official might say if they were here, which is, because their forecast doesn't have a recession. And what's key to this is that the nature of the U.S. labor market will shift. In other words, what they have right now is a huge number of vacancies for everybody who's unemployed, historically high. It's almost 2 to 1. It's come down, but it's almost 2 to 1, which means that there's a lot of pressure that's there in the labor market. I lose my job, but I can basically find another one. And also what you have is a lot of people quitting their jobs in the United States because, again, they're confident they can find a better job somewhere else. It's not the kind of thing you do if you think there's about to be a real recession. Now, the Fed's forecast, and some of them make this more explicit than others, basically relies on those vacancies going away more than unemployment going up. It's possible. It's never happened before, but we've never had COVID and these other factors before. My sense is the balance of probability. It's much more likely that unemployment's going to go up. And, once you get more than 0.5 percentage point of unemployment,
you get a recession.
Yeah. The numbers are even lower than that. And the U.S. probably needs to get about 1.5 or 2 percentage points more of unemployment in order to get inflation all the way down. So it's not really, the balance of probabilities here make it very likely that we end up there.
Okay, let's move on to another topic of yours that you talk a lot about in terms of climate change, right? So one of the stats that you've given is that we need to see an 8% reduction a year in terms of carbon emissions for the next 20 years to meet 1.5 increase in the global temperature. COVID year when everything stopped was 7%. So
let's round it. So basically we got there, but we only got there by shutting down a third of our economy, right?
Correct. So is that the solution? Is it game over, or is that what we have to do?
Well, I think it's a very important point. It's a great question because it's a point I often make to some whose solution to climate change is stop doing what you're doing, stop living the way you live, stop traveling, we did that, and we barely made 1 year's worth of reductions. We all did that, and so what it reinforces is that we need to invest and grow in order to get emissions down. So in Asia, it's an additional $1 trillion annually, additional, not just repurposing of energy investment, but it's an additional amount of that in the energy sector largely, in order to get emissions down, start following that path. Globally, the number is somewhere between 3 and 4 trillion. So it means that there's this big need for investment. That's one point. The second point is that actually the scale of investment opportunities that are profitable, highly profitable, running through infrastructure, renewable power, and others today, including very much in this region, are enormous as well. And the other bit of good news is that the financial sector, and Standard Chartered has been at the lead in this, has swung around and is now looking for these opportunities, in fact, valuing their own balance sheets on the basis of whether or not their loans, their investments are aligning with that pathway you talked about. And to put numbers around this, because this is all about numbers, the orders, I give you big numbers for investment, the collective balance sheets of those financial institutions who say, we're going to shift over time to backing companies that have plans to take the curve of emissions, their curve of emissions like that, it's $140 trillion. That is 40%. It's more than 40% of global financial assets. It's absolutely enormous. And it means that there's lots of people at Standard Chartered and other banks and other asset managers that are fanning out to their clients and saying, listen, if you've got a plan to get emissions down, we're going to help you. And that tells me two things to bring it back to the macro, away from the climate, but back to the macro. One, there's going to be a lot of investment. Maybe not as much as we need. I mean, I can't guarantee it, but there's going to be a lot of investment. That's going to bring growth, a lot of growth with the multipliers from that. And secondly, on the margin, that's going to push up the average interest rate that is needed to clear the economy, the so-called equilibrium interest rate. And even my friend Larry Summers is beginning to acknowledge that maybe secular, well, I shouldn't say that. Larry's very disciplined. But this is one.
You don't always agree on things.
Well, yeah. And I know it when I do. I hear it when I don't agree with him. But I think we recognize that the balance of probability is that equilibrium interest rate is moving up.
Yeah.
And that means that, for a given level of interest rates for the Fed, or the Bank of England or Bank of Canada, it's not as restrictive as it would have been a few years ago. So they need to have restrictive policy, and it means that it won't come down as much. As well.
So one of the things we'll talk about today is scheduling your investments. I guess in the climate change space, how do you see the scheduling of investments and rollout of measures to address it?
I think we're in a phase right now where wind, solar, wind power, solar power, obviously hydro, nuclear, these are proven technologies. The first three are, I would say almost wildly economic relative to the alternative. So if you're looking for new power to be brought on, it just makes sense. What's called the levelized cost, so the all-in cost is just cheaper than coal. The issue, very much an issue in this region, issue in Indonesia, for example, Vietnam, is a lot of the coal is relatively new build, and so the issue is shutting that down in order to ramp it up. there's been a couple of big financings that actually are going to do that, which will help, and these are $20 billion orders of magnitude financings, and they'll help make those reductions actually quite quickly. But the way I would think about it, to bring it back from an investment perspective, so there's big infrastructure, proven technology, rolling out at scale around the world, Europe, the US, this region increasingly in Asia, and that is the story of this decade. Now, and that's infrastructure, low to mid-teens type returns, very clear, and it's something to scale. At the same time, the new technologies that are going to be the stories of the end of this decade in the 2030s, think hydrogen, carbon capture and storage. There's opportunity to invest in those today, but let's be clear, you're investing in growth equity, you're investing in higher risk. But these are technologies, and I can't guarantee you on the companies, but these are technologies that, in my view, will work, and they pretty much have to work if we're going to be on that path. And then, but that's, growth equity. People in this room know how to take that type of risk. You know how to take that type of risk. And then the last set of technologies, which are sort of the later stages of the 2030s and the 2040s, that's something called direct air capture. So you're taking carbon directly out of the atmosphere. It's small modular reactors in nuclear. It's potentially fusion, but as you can probably sense as I'm saying all that, this is more on the venture capital end of the spectrum. And you know what? We need all of those. Last point, if I may, in terms of how we say that, get it in, because I can see the clock going, which is that there's a whole emerging class of investments in nature. So think reforestation, think of mangroves, think carbon credits, even biodiversity credits. And those will become important because, to go back to where you started this question, which was around the 8% a year we need to get down, those calculations are based on the simple physics of climate change, which is it's the stock of carbon in the atmosphere which drives the temperature. And there's something called the carbon budget, which is being eaten up as we emit. Well, nature-based solutions, reforestation as an example, they expand the carbon budget. And actually there's lots of reasons to do it, but there's huge value to doing that because it creates more time for us to bring on hydrogen, to bring on direct air capture, to bring on these other technologies as we roll out.
Okay. So we've got a couple of minutes left. I do want to touch on the crypto or digital asset space, right? So every morning, I wake up, I read the FT, I see some revelation of what's going on in this space. How does this play out?
Yeah, it's, it's not well. It's a headline.
Thanks.
Because, it's not well. And I think the important thing, I was thinking about this, we were talking about it earlier, and I kind of divide it into, if I take crypto as a whole, and what's useful and what's potentially useful and what's useless. Okay. And I'll give you a headline of what's useless. In the end, a cryptocurrency is useless. In the end, it's useless. To be absolutely clear, the punchline, because it doesn't truly fulfill the roles of money, what it purports to do. And
they're often bad for the environment, by the way.
Well, they're bad
right?
for the environment, but that's one of many reasons. Yeah. But in the core, and one of the ways to think about this is when you have over time we've had innovations in the monetary system. Banknotes was an innovation. Banking itself, so-called fractional reserve banking, was an innovation. Actually, because of people like Standard Chartered, 85% of money is private money. You create it when you make loans. But always what happens is that money is tied back 100% instantaneously to the central bank, to the risk-free money. But the whole point of crypto is not to be tied back. It is not stable. It does not work in the end, and that's why we see the collapse. On top of that, it isn't actually a proven ownership of the underlying asset. So crypto is, I'm afraid, in the useless camp, which is pretty big. But the technology, distributed ledger technology, useful. Stable coins potentially useful, although, and I'm running out of time, We want central bank digital currencies to be at the heart of that. I think in the end will be more useful. The application, which last point, time up, which I think will be very useful for this group, is that what is possible through tokens, i.e. tokens of token value, is to have greater ownership of a much broader range of assets. So we all hear about NFTs, and a lot of focus is on the art world. Okay, you can make your own judgments about the values of those, but having fractional ownership of real estate, signature real estate here in Singapore, and being able to transact that costlessly and build out a portfolio accordingly as a consequence, and many other applications I think are there. That's where we'll ultimately head. I think we'll end up with a system, and the MAS is helping to lead this with central bank digital currency at the core, much cheaper cross-border transactions, much lower core role for the US dollar 10 years hence as a consequence of that, and in a much broader portfolio space for individuals. So your job's going to become that much more interesting, and that much more, and your opportunity set in the audience here and virtually is going to become that much greater. Some good will come.
Okay, even if there's some useless elements of it.
Yeah, just avoid the useless stuff in the interim, though.
Mark, a pleasure talking to you.
Pleasure,
Thank
Steve.
you so much for your time today. It's been really insightful and hopefully useful for everybody in the room and online as well. So thank you so much.
Yeah, great. Thanks, Steve. Thank you very much.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.